So guys, earlier on we gave signal. We are back again with vix75. We gave signals for vix75 in the in our groups. So to those guys who took the signal, congratulations, because you are in deep profit now. So now let's check the overall results and performance overall since we gave the signal. So if you can check from the time we gave the signal, right, and then this was the current profit at the time when it was running. So but this also is the minimum lot sizes. So some people may use the bigger lot size. It means now if you use the 0.01, you are now up by $40 per trade. So it will be determined by how much you leverage. So however, you can see from this chat, this was the performance for that signal. We went in deep profit, so congratulations guys. And I want to also go to the chats and let's see. In the meantime as well, check the profit. Well, check the profit. We are now up by $14 per trade at that time, right? So let's go to the chats. So this is the current price where the market is. So now let's teach you the strategy, guys, as well. It's important that you understand why we gave the sell opportunity at the time. So I love trading with high time frame. So on this high time frame, if you check on H4, right, so the first thing that you need to look at is the high of the day and the low of the day at that time. So but let's identify our levels where we see the buy side liquidity. So we can just put it somewhere here on this high time frame, and then this is our buy side liquidity, right? And then here we're going to also identify the area where as well we know that there is liquidity as well, right? So this will be also our sell side liquidity. So now we have spotted our levels. There is buy side liquidity, there is sell side liquidity. Let's go to a lower time frame so we can be able to see. So from this side we gave the signal somewhere on this point. Let me identify with the arrow. Right, so this was the entry, and so from then what we do is we check where the market broke out from the previous high. Let's zoom this in because this is this side. So it broke out from this area, right, and then went up to this side to collect liquidity from the buy side liquidity, right? And after grabbing that liquidity, obviously some people got in here with a buy and then thinking that they're in long-term buy and they're still comfortable at the time. But look what happened. The market started dropping, and now this time, because of it knows that it's running away with this liquidity that it grabbed from this area, it start running away with that liquidity, right? And then going to give it to the sides, to the sell side where there is also liquidity as well, because market moves from liquidity to liquidity, right? So now let's look at something very interesting here. From after grabbing this liquidity, our entry came from this level after confirming the breakout of this structure, right? There's this structure as well that you need to respect. This breakout structure, let's identify it so we can see. So we mean where the market broke out, right, from this side. So what we're going to look at now is, okay, the market broke out from this level, and then this is the breakout, right? And it also break out from this level as well. This is the structure as well. If you check, this is a structure. So that we identify on the higher time frame H4. So they broke out from this level. Obviously, there were people who positioned their buy entries here. Some people bought, you know, some people bought from this. But now the market came aggressively, running away with that liquidity, taking them out on this level. And then now they stayed, you know, beneath their level, you know. So which simply means now, what are they going to do? So after break of this structure, we look at where the market can, you know, can actually go, right? So, but we're going to identify that level correctly using a lower time frame as well. Because if you check on this breakout, if you go to lower time frame, let's put it this way. So on this is the structure that we identify on H1, right? So this is how you see it on M5. So it broke out from this structure. So now it's retracing upwards. So we look at the possible levels where it can, you know, start rejecting from this level. So let's zoom it in. So we see there is a possible level that you know, it might reject from this. I mean, it might go and retest this area. This area here, we can just underline it. So even if you sold, guys, doesn't mean that the market won't come back to your level. You know, you just need to learn money management skills so that you know how to protect your profit. You know, close some entries in profit. You leave at least maybe one entry to run if you want to be a long-term trader on that one. So now we're going to wait for the market to retrace to this level, right? So those who missed the sell opportunity, you don't just enter a signal because the signal was given out. Because sometimes you might find that you know, we gave the signal here and then some people didn't manage to, you know, get in earlier because they were still busy, maybe at work, and still maybe they were not even closer to the phone at the time. But they want to enter where the market has already gone. You start entering here, so you see what the market will do. The market, you know, when it rejects, then you know that, you know, you're in high risk, because now the market might leave you on this area and start going here, and then you already position yourself with a sell, so you lose some of you know, your position is in too much risk. But look at someone who entered here. Even if the market start rejecting from this level, they still got a chance to run away with some little profit that they made, right? But while you are running in a loss, because now if the market comes to this area here and then you entered here, then you're still in loss, right? So now we're going to wait for the market to start coming here. So now, and you can then, you know, take a little risk to enter a sell, and then make sure you protect your stop loss and put it here, so that if it rejects this level, if it rejects or break out from this structure, you know that a possible level that it might retrace from could be this level here, you know. And then you start being patient with your entries. So let's go back to the higher time frame. So from this high time frame, we have identified our level. So we said this could be you know, the risky sell opportunity, but we know that the real sell opportunity, right, could be here, should be here, up here, you know, because of market runs from liquidity to liquidity. This would be another entry for a sell, right? But it means you have to be patient until the market comes here. You know that when the market start rejecting, possible entry again could be this side. So if this one, obviously this one won't hold, you know, but won't hold for a long term, because of for a long term sell, it must confirm here, right? Because now it broke the structure from this level. After every break of structure, if you check from this break of structure, because here is the break of structure. The market broke this level. It must then go back and retrace from this area again, you know. So let's go to day 1. This is our daily time frame. So what's happening here? We look at where the market formed the insufficiency. So we look at this insufficiency here because of, if you check, this was the previous spike, right? So from this side, if you check, there was no spike in between this level until here, right? So now this means there is actually some liquidity here. There's too much liquidity here. So now what does the market do? Market runs down to collect this liquidity that is here, to fill up this gap. Actually, you know, some people call it filling up the gap. So it's running for sell side liquidity, because already, if you check from this side, this was the structure, and then it broke out with the buy, right? And then broke out from this structure, went back to up there to collect the liquidity that was here, you know. So, and if you check as well, this was the only spike that was here ever since, you know, this movement here, you know. So like we say, market moves from liquidity to liquidity. So now this was supposed to fill this area, and we are now running to this sell side liquidity. So now let's underline our level, our spike to spike movement. So just put them on every both up on the sell side, and identify all the spikes that are there right here. So what happens? There's you see the insufficiency that I'm talking about. This is the gap. This is where the market must start playing its pricing here. So we're expecting it to move on this area, filling in this insufficiency here, then start moving to the upside. So this will be our confirmation buy on this side. Then you know that it will start running to this position there, up there. So that is it, guys, with the vix75. Make sure you practice proper risk management, and if you're still holding, make sure you put your stop loss on the entry level, and so that you can break even. So now let's see here, let's put our arrow so that we just wait for the market to do what we have analyzed here. So put your liquidity to liquidity. So this is for the spike to the body. So you look at the last previous rejection. So this is the last red candle, because if you check, let's check the last red candle here on this. You can see this is the last red candle because of the spike is the last one here, right? So from this spike, it's forming what we call an order block. So what is an order block, guys? Order block actually refer to a specific price area where large market participants, such as institution traders, so they start entering here, they start position themselves for the nice entries. So but we call it market moving to collect this to fill in the gaps, to fill in the insufficiency. So let's see how it will go. Let's put this arrow here. and let's let it run. Now again, we have identified our spike to spike from here to here, right? So it will be the way it will be playing. But that is not last. You look at the last previous red candle, then you move your line to the last previous candle. You can just draw in the spike and then to the body, or you can even do it 50%, still fine. But you know that the early entry will be nice one here, and you know you're safe because it's filling in the gap. So let's go to lower time frame. Let's see our position. So now it's going to that retest that we spoke about earlier on lower time frame, right? Short term sell, short term correction for buy. We have identified our levels. If you check this ones, so once you have identified your level, you know the market will just move correcting to your levels and then going back, continuing in with its long-term trend. So let's move again to H4, 4-hour time frame. So here on 4-hour time frame, let's draw in our lines and put them. So liquidity, that will be the liquidity, right? So sell side liquidity, remember we said sell side liquidity, there's buy side liquidity. So this is where we're going to target our area, where we're going to say, you know what, we position ourselves for buy opportunities, or where we know the market might be enough for buy opportunities. So let's look at it at daily time frame. So daily time frame, you can even see it very nice, very nice, very nice. Oh, nice. So you see, let's move this to here. So here is our liquidity. If you check, this is our liquidity here, and we're patiently waiting for the market to come to that level. But obviously the market won't just shoot straight to that level. It will go up, it will go in waves or in circulation, meaning that it will still sell, but then going up as well, correcting some smaller yana levels and then going back again. So that's how it works. So let's see, and let's draw in. So we can even put 50% line here for the last previous candle, but because of the market moves from liquidity to liquidity, we just mark our liquidity here and see how it will go. So that's how, guys, you analyze this. Otherwise, you can even underline this last previous level here on the downside. So this is where the market rejected previously. No. So you know that if the market doesn't actually reject from this level, then it must come and grab this liquidity here. This will be the liquidity here. Because now check weekly one, guys, or weekly time frame. Check weekly time frame. You see, weekly time frame is just a candle, right? This red candle. So but through the candlestick method, this this candle must be filled. Let me just draw in with different color. Let me use this one. Let me edit color. Let's use red. So here this candle must be filled, right? Because this was the spike of this weekly candle, but through the candlestick method we know that there's high chances that it must fill in this gap. But on this candle, right? So meaning that if we check next the coming week or closing of this week, the closing of this week, we must actually be able to see the candle like this. Let me put it here, it's fine. You see, so it's perfectly, it's to this side. So let's just put it here and see if this will play out this way. So yeah, let's see it, guys. So remember, trading is about patience. If you are not patient, the money will move from you to those who actually are patient, who are willing to take proper risk, and who are willing to accept all possible drawdowns until they are back to their level. So let's see.